Have you ever looked around a parking lot and wondered, how is everyone affording this? That question may have already cost you $200,000. There's no receipt anywhere with that number on it. You pay it as a comparison tax twice. First, on the things you buy, because everyone else looks further ahead. Then on the investing you keep postponing, because catching up starts to feel impossible. A car, a trip, and one blank box on an enrollment page. 3 decisions. The third costs more than the first two combined, and it's the only one that never feels like spending. Think about the SUV you parked next to this morning. You know its make, maybe what it costs. But you don't know whether the person driving it owns it, leases it, financed it for 7 years, or stopped contributing to retirement to make the payment. You saw the car, your brain invented the balance sheet. I call that the highlight reel ledger, the imaginary financial statement we keep for everyone around us. It records every asset we can see and none of the liabilities we can't. The house goes on it, the mortgage doesn't, the vacation goes on it, the credit card balance doesn't. Nobody has to say a false word to give you a false picture. That's how everyone around you can lie about their money without lying at all. They show the purchase. Your brain finishes the story behind it. And it almost always assumes they can comfortably afford everything you see. Money has a visibility problem. Spending is public. Security is private. The car sits in the driveway where everyone sees it. The payment sits in an app where nobody does. Quiet wealth is nearly invisible. Nobody notices the older car in the lot that's paid off. The same SUV could belong to someone with a 7-figure portfolio, or someone one missed paycheck from panic. The object can't tell you which, and even when someone can clearly afford the payment, that tells you almost nothing about the trade-off behind it. You don't see whether the car replaced investing, delayed a debt payoff, ate a bonus, or simply fits easily inside a much larger income. The same purchase can mean wealth, or strain, or just a different set of priorities. From the outside, all 3 look identical. The point isn't that everyone's secretly broke. Some people really are doing well, they earn more, started earlier, got help you didn't. The point is you can't read someone's finances from the part you can see. But that's exactly what we do. We turn spending into evidence of wealth, then use it to grade ourselves. That's the scoreboard you've been losing to, their highlight reel ledger against your honest books. And it creates 2 reactions. Some people accelerate, others freeze. A lot of us do both. First, you accelerate. The car you already own stops feeling neutral. Nothing mechanically changed, it still starts, still gets you to work. But now you notice what everyone else is driving. Say comparison nudges you from the average used car payment, around $537, to the average new one, about $767. If that choice adds $230 to your payment for 72 months, that's $16,560, the payment difference alone, before the higher insurance. You didn't buy more transportation. You bought relief from feeling behind. Then the trip. $5,000 on a card at 22%. Pay $140 a month, and it follows you home for nearly 5 years. By the time it's gone, that $5,000 experience has cost about $8,200. Between the car and the trip, the reaction tax is approaching $25,000. That's the obvious version. You can see what you bought and say, that probably cost too much. But comparison creates another reaction, and this one is far more expensive. You freeze. You don't skip investing because you don't care about your future. You skip it because looking directly at your finances makes the gap feel real. You open the enrollment page, you reach the box asking what percentage you want to contribute, and the thoughts start. I'll pay off a few things first. I'll start after the next raise. So, you close the page, nothing leaves your account, no new debt appears. It feels cautious. It might even feel responsible. Now suppose 2 people both invest $500 a month. Both stop at 65. One starts at 30, the other waits until 35. From 35 on, they contribute exactly the same amount. The only difference is the 60 deposits the late starter skipped between 30 and 35. At an illustrative 6% a year after inflation, those missing 5 years leave them with roughly $210,000 less at 65 in today's money. Markets won't do exactly that every year, but the lesson doesn't need a perfect forecast. Each $500 month skipped that early can quietly cost $3,000 to $4,000 of retirement wealth. The car and the trip cost about $25,000. The delay cost more than $200,000. The first tax was charged on things you bought, the second, on the future you kept waiting to begin. That's why there was no receipt. The money was never in the account long enough for you to feel it leave. You looked at your real account. Then you looked at everyone else's edited life. And you concluded something must be wrong with your math. Nothing was wrong with your math. The comparison was wrong. You were comparing your complete balance sheet to everyone else's marketing. You were keeping honest books. They were showing a brand. Two people on the same street, similar incomes. One checks their accounts every quarter and knows exactly how far they have to go. The other hasn't calculated net worth in 3 years, knows the payments fit for now, and feels successful. The one paying attention feels worse, not because they're in a worse position, but because they're looking directly at it. That discomfort isn't a verdict on your finances. Sometimes it's just the sensation of seeing the truth without a filter. And financial truth rarely looks impressive early. Building wealth often looks exactly like standing still, which is why visible spending is such a convincing counterfeit. It looks like progress immediately. Real progress can stay invisible for years. You were never competing with other people's wealth. You were competing with evidence of their spending. Those aren't the same thing. So 3 things change from here. First, replace the public scoreboard with a private one. Pick one day every quarter. Add up what you own, subtract what you owe, write the number in a note on your phone. Then compare it to your last number, not your coworker's truck, not the house down the street. The only earlier financial life you have complete information about is your own. Second, use the invisibility test before a big purchase. Would I still want this if nobody could ever see it? If yes, it may genuinely serve your life. Enjoy it. If the answer is no, you're not only buying the thing, you're paying a status fee. Third, go back to the page you keep closing. If there's an employer match, capture the full amount available to you. And if the right contribution keeps stopping you from starting, start with an amount that feels almost too small to matter. $50, 1%, whatever gets you past the box. Its job isn't to fund your retirement, it's to end the emotional veto. Once the contribution exists, you're no longer trying to become someone who invests, you're just deciding when to raise the number. Stop requiring yourself to feel caught up before you begin. Investing is one of the ways you catch up. The people around you performing wealth aren't your opponents. Most are doing exactly what you were, seeing fragments, filling in the gaps, guessing with worse information than you now have. In this example, $16,560 on the car, about $8,200 on the finance trip, more than $200,000 through 5 years of waiting. Your exact numbers will be different, the mechanism won't. You see someone spending, you imagine their security, you feel behind. Then you either spend to close the visible gap or freeze because the invisible one feels too large. Understanding the reaction tax doesn't stop it. Clarity isn't a payment. A different decision is. So next time you see the new SUV in the lot, you'll still see the car, but now you'll also see the 72 payments you know nothing about. And next time you open your own account, you won't compare it to someone else's driveway. You'll compare it to where you were 3 months ago. Subscribe for the real math behind the financial stories we tell ourselves. Because the same distortion doesn't stop with other people's money. It changes how you read your own income too. There's one more number you've been getting wrong, the one you check most and understand least. Your salary. That's next.